Most people think wars are fought with bullets and bombs, but some of the greatest destructions in history have actually occurred through printing presses, interest rates, and exchange rates. These are wars you will rarely come across in high school history classes, wars where armies do not march, yet countries collapse. These types of wars are called currency wars. And once you begin to notice them, you see that in the rise and fall of empires, monetary policies have sometimes been more decisive than a commander. If you think this is only an economic issue, the reality is much deeper. Currency wars decide which people will live better, who will struggle, who will be powerful, and who will remain dependent on others. Moreover, these wars are still ongoing, quietly and often unnoticed, yet affecting even the value of the money in your wallet. The logic of a currency war is actually quite simple, using money as a weapon. For example, deliberately lowering the value of a currency to make exports cheaper, or flooding the market with cheap credit to push rival economies into difficulty. Sometimes it is about accumulating gold or reserves to restrict others' ability to act. At first glance, this strategy may seem clever. However, in reality, the situation is somewhat different. From the perspective of economic history, this is often compared to chemical warfare, because while you poison the enemy, you ultimately affect yourself as well. One of the clearest examples of this in the modern era occurred during the Great Depression. After the 1929 stock market crash, the global economy fell into serious chaos. Countries had to sell their goods abroad to survive. However, as global demand rapidly declined, many countries found the solution in devaluing their currencies. In 1931, Britain abandoned the gold standard and the pound began to lose value rapidly. In 1933, the United States followed a similar path and reduced the gold content of the dollar. Countries like France, Italy, and Japan also entered the race to cheapen their currencies. However, the expected positive outcome did not come. Instead of reviving trade, it led to what economists call a beggar-thy-neighbor cycle. Imports became more expensive, living standards declined, and increasing economic hardship eventually created the conditions that led the world to the Second World War. In fact, currency wars did not emerge in the 20th century. A much earlier example can be found during the Roman Empire. The trust in Rome's silver currency, the denarius, played a major role in determining the empire's strength. However, as the empire expanded and the costs of wars increased, the rulers found a way out, reducing the silver content of the coins by mixing it with cheaper metals. At first, this change was very small, a little less silver, a little more copper. But over time, the silver ratio, once at 100%, dropped to below 5%. This was essentially the ancient world's version of a printing press. The result was predictable: inflation, loss of trust, and economic weakening. Alongside barbarian invasions, this internal economic decline also contributed to Rome's collapse. By the 20th century, the situation of currency wars had become more complex. After the Second World War, the Bretton Woods system, which reshaped the global financial structure, aimed to eliminate such competition by fixing exchange rates. The US dollar was tied to gold, and other currencies were linked to the dollar. In theory, this system promised stability. However, it also created a new balance of power. Because while the United States controlled the dollar and with it gold, it gained the ability to increase its influence globally through the financial system. For countries that did not follow the rules, financial pressure replaced military intervention. This method stayed more in the background, was cleaner, and often more effective. However, this dominance also had a cost. By the late 1960s, the United States began producing more dollars than its gold reserves could support in order to finance both the Vietnam War and major social programs. When foreign governments realized this, they started exchanging their dollars for gold. As gold reserves rapidly declined, U.S. President Richard Nixon made a historic decision in August 1971, ending the convertibility of the dollar into gold. Thus, the Bretton Woods system collapsed, and the world entered a new era, the era of floating exchange rates. This marked the beginning of a new phase of currency wars. One of the most striking examples of the modern era is the Plaza Accord signed in 1985. At that time, Japan was experiencing rapid growth, and thanks to its strong exports and disciplined production, was running a large trade surplus with the United States. Washington was uncomfortable with this situation. In response, the United States, Japan, West Germany, France, and the United Kingdom agreed to lower the value of the dollar while increasing the value of the yen and the German mark. Officially, it was meant to restore trade balance. However, in reality, it was a coordinated currency attack. The yen quickly appreciated significantly, Japanese exports became expensive, and a massive asset bubble formed in the country. This bubble burst in the 1990s, leading Japan into a long period of economic stagnation. Without firing a single shot, the United States had effectively used financial markets to achieve this. The interesting aspect of currency wars is that they do not seem like conflicts in real time. They often appear as interest rate decisions, central bank statements, or international meetings. Yet their effects are real. Factories closing, people losing jobs, and savings losing value. The Asian financial crisis of 1997 is a clear example of this. Thailand's currency, the baht, collapsed due to speculative attacks, and the fixed exchange rate system was abandoned. The crisis quickly spread to Indonesia, South Korea, and Malaysia. Currencies lost value, economies contracted, and millions of people suddenly became poor. If you think this is only in the past, you may want to reconsider. According to many economic experts, we are currently in a period referred to as Currency War 4.0. The methods have changed. Central banks keep interest rates at very low levels, inject money into the market through large-scale quantitative easing programs, and use financial sanctions to exclude countries from the global system. There is especially a quiet but dangerous rivalry between the United States and China over the influence of money. The dollar is still the most widely used reserve currency globally. However, China is trying to expand the global use of the yuan, developing alternative payment systems and accumulating gold. Meanwhile, developing countries are forced to maintain a delicate balance. If they keep interest rates low, investors may move their money elsewhere. If they raise rates, economic growth may slow down. The pandemic in 2020 accelerated this process. Many governments created unprecedented amounts of money to fund stimulus programs. In the United States alone, trillions of dollars were injected into the market within 2 years. At first, the situation seemed under control. Stock markets rose, unemployment decreased, and spending increased. But eventually, the bill comes due. In 2022, inflation reached its highest level in 40 years. In response, the U.S. Central Bank began raising interest rates. The effects of this decision were not limited to the United States. A stronger dollar made imports more expensive for many countries, triggered debt problems in places like Sri Lanka, and pushed weaker currencies toward collapse. Due to global economic interconnections, policies aimed at stabilizing one country can disrupt many others. This is precisely the most challenging aspect of currency wars. They are rarely confined to just two countries. They are conflicts in which all participants in the global system are forced to take part. History shows that currency wars rarely end easily. They often conclude with something breaking. A currency collapses, a new financial system emerges, or political turmoil forces change. In the 17th century, the Dutch guilder dominated global trade. In the 19th century, the British pound took the lead. In the 20th century, the US dollar became central to the global system. Each of these transitions was complex and tied to wars, defaults, and economic fluctuations. Today, many people are curious about what the future holds. Will the dollar remain dominant for the next 50 years? Or will a multipolar system emerge with central bank digital currencies competing? Or will decentralized cryptocurrencies gain enough trust to pose a serious challenge to the current system? These questions are not just theoretical issues for economists. The value of your savings, the cost of your daily life, and your job security can all be affected by these developments. The most dangerous aspect of currency wars is that ordinary people are often not even aware of them. When a bomb falls, you hear it immediately. But when a currency loses 20% of its value, you usually notice it only when grocery prices rise. By the time headlines reveal the real situation, it is often already too late. For this reason, financial education is becoming increasingly important. If you can recognize the recurring patterns throughout history, how inflation erodes real wealth, and how central banks and governments use financial systems and monetary policies as tools of control, you can take steps to protect yourself. You can diversify your assets, invest in options that retain value outside the financial system, and avoid the illusion that the balances in your bank accounts provide real security. Ultimately, the reality that currency wars reveal is this: money is neither neutral nor merely a medium of exchange. It is also a tool of power, strategy, and sometimes destruction. The winners are not always the most productive ones. More often, they are those in the strongest position within the system. The losers are those who realize they were part of the struggle only when it is too late. History may not repeat itself exactly, but similar themes constantly appear. The debasement of currency in Rome, the devaluations of the 1930s, the Plaza Accord of the 1980s, the monetary expansions of the 2010s, and whatever awaits us in the future. Names change, eras change, but the methods often remain similar. For this reason, the next time you hear about a currency adjustment, an unexpected interest rate cut, or a new sanction, do not see it as just a simple economic development. Sometimes these can be the opening moves of a larger conflict. And remember, you do not need to be a soldier to feel the effects of currency wars. Living within that system is enough. Understanding this is the first step to survival. The second step is taking action before the storm arrives. Focusing on assets that create real value rather than those that are valuable only on paper, questioning the system and studying historical examples can help in this process. Because when money turns into a weapon, the safest place is usually where you're not its direct target. If you want to see the financial side of history, like the video, share your thoughts in the comments, and subscribe, because the next story might be more familiar than you think.